reasons. Some people carry myths about debt mutual funds, for example, poor returns, taxation is high, etc. And some people are not even aware of debt mutual funds and what power do they have. So I'm going to share with you certain reasons on why it is a definite must. It is there in my portfolio definitely, and it is something which I recommend to all our elite subscribers, that they must have something in the debt portion of the portfolio, which is a certain balance they need to maintain based on their investing strategy. And it's very, very important. So I'm going to give you why it's important to have debt mutual funds. But before we do that, let's be very clear that we're not talking about comparing debt mutual funds with, let's say, returns of equity or real estate or commodities like gold, etc. Debt is a separate category, okay? And debt investment essentially is a contract based investment where you know beforehand how much you're going to get in return, okay? For example, fixed deposits, bonds, and EPF, PPFs, they're all debt based investments primarily, and therefore you know beforehand, okay, this is the approximate returns I'm going to get, and this is the time period for which I'm investing, and so on and so forth. So don't compare them with other asset classes. Now, for a balanced portfolio, you need to have a certain set of asset classes. And why a portfolio needs to be balanced is a separate discussion altogether. You will need to have equity, you will need to have debt, you will need to have commodities, you will need to, in some cases, you will need to have things like art and coins and things like that. But those are very, very niche asset types. Real estate is another asset class, but I really don't recommend real estate, as we discussed in the last video. So I'm going to talk about debt-based investments and why you should have it in your portfolio. Point number one, returns. This is one of the reasons why some people do not invest in debt mutual funds, and especially this budget. There has been a talk about taxability and other stuff, which we'll talk in a separate point. But in terms of returns, debt funds would typically give you like 7 to 7.5% average returns over a long run. But if you are smart enough, if you understand a little bit about debt mutual funds, how their returns move with the interest rate cycle, then you can even get 9.5, even 10% returns from debt mutual funds. But you need to be a little careful. You need to be having a little bit of experience, or you need to be in touch with your financial advisor who can guide you what's the right time to invest in debt mutual funds. Yes, we're talking about timing here because debt mutual funds are much, much more predictable in terms of their movement than equity. Now, so returns. So that's the kind of returns. So if you compare these returns with any other debt-based investments, like 8-9% returns with any other debt-based investments, primarily it's probably EPF which comes close to it, or to a certain extent PPF, but definitely not FDs or bonds. So an EPF, PPF, the challenge you all know is the liquidity challenge, where you're locked in an investment for a very, very long time, and it's more of a retiral based investment than anything else. But if you're looking at actively managing your portfolio and getting better returns from your portfolio, then you need to have some liquid debt based investment, and debt mutual funds are some of the best investments you could ever do on the debt side of your portfolio. So returns wise, it's one of the best in the category if you're looking at liquidity as well as returns together. Coming to the second point, which is liquidity. Now, these are the only debt based investments where you can just come in and move out at your will, just like a savings account. Okay, you deposit something today, you can withdraw tomorrow. You deposit and whenever you have money, and you withdraw whenever you have money. Although this is not the ideal way of investing in debt funds, but you have that flexibility with you. You can put in and go move out at your will. Okay, and there are no constraints like you have to be invested for minimum 1 year or 2 years or 1 month, or and nothing like that. It's just like a savings account, as I told you. And even on a taxability perspective, there is no difference whether you're investing for 1 year or 3 years or 2 year or short term, long term. Now everything is all same taxes. So from a liquidity perspective, this is one of the best non-equity investment, one of the best debt-based investment. The debt mutual funds, if you invest, you have a choice or a freedom to withdraw at any point of time. Third, this is one of the rare investments which can help you generate, if I call it, let's say, pension or passive income or a regular cash flow as you would need it. Now, when we are talking to people in the elite program, people are primarily here in the program because they want to get financially free, and they're all on their journey. And the important point is not how much net worth you need, not only that, or the another important point is whether that net worth can generate a regular cash flow to feed your monthly expenses and other expenses required for other events in life. If it cannot, then it's not a well structured portfolio for you. And so, for example, if you have investments in EPF, PPF, and real estate, how will you generate a monthly cash flow, right? So, you have a challenge there. So, you need something which can generate a monthly cash flow. Now, debt mutual funds have a beautiful plan called as a systematic withdrawal plan. Just like you have an SIP in equity mutual funds, debt mutual funds allow you to have a systematic withdrawal plan also, which of course is there in equity also. But again, in debt mutual funds is one of the debt based investments, one of the rare ones which has a systematic withdrawal plan, which means that if I have a big enough corpus in debt mutual funds, let's say 1 crore, and it's giving me like, let's say 8% returns, which is like 8 lakhs a year, or which is like 70,000 a month, and I only need 50,000 a month. So I can just set up an SWP or a systematic withdrawal for 50,000 rupees a month, and my debt mutual funds will keep growing by another 20,000 rupees a month, and whatever returns they're getting, and I'll still keep getting 50,000 rupees a month. So that's the beauty of debt mutual funds. It can help you sustain your post freedom or a post retirement life beautifully well. It's much better returns than annuity or anything else you've heard of. Okay, and if you're, as I said, if you're smart enough, you can get returns which you can't even think of in any other debt based investment. Okay, so returns, liquidity, cash flow. Fourth, tax treatment. Now, on tax treatment, this year has been a lot of noise around the tax advantage being withdrawn, the long term tax advantage from debt funds, which is fair, because now they are at par with fixed deposit taxation. So if you invest in, so what are the options in front of you? If you're investing in a debt based investment, you have fixed deposits or bonds. Most of them are already fully taxable. Now debt funds are also fully taxable. So that brings them at par in terms of taxability. But return wise, they're still much higher than FDs or bonds. Um, Fifth point, which is again a very important point, is the volatility of debt funds. Now, most of the other asset classes on the debt side, for example, EPF, PPF, FDs, bonds, whatever we talked about, they're all linear growth. Okay, so they're not volatile. So you exactly know on this date I'll have this much amount in my hand. Not so with debt funds. They are slightly volatile. Of course, they're much lesser volatile than equity funds, because they invest in debt market and equity funds invest in equity market. But this volatility is actually beneficial for us. First, volatility in any case is beneficial if you can sustain the volatility, because it allows you to average your buying cost. In equity, the challenge is volatility is so high that people cannot sustain that many times. Those who can sustain it get massive returns from equity, above 15-20% easily. But those who cannot in equity will be able to sustain it in debt funds, because debt funds will never give you negative returns. I mean, it may give you negative returns for a very small period of time, maybe a few months, but overall, it will never give you negative returns unless the entire economy goes in recession and interest rates become negative. That's very different and a rare scenario, but otherwise, they will never ever give you negative returns. And the volatility is quite less compared to equity funds. So it's very easy to, ride on that volatility for almost all investors. And in fact, volatility helps us benefit, because if we have understood in depth about debt funds, or if you're in touch with a good financial advisor, he can tell you that how to, leverage that volatility to generate even better returns from debt funds, like kind of double digit returns, 10% kind of returns, depending on the interest rate movements. So debt funds really are a piece of your portfolio which you must have. uh, Another important aspect I want to touch upon is people sometimes ask me why at all to get into debt based investments. If equity is giving us better returns, why not put everything into equity? It has liquidity also, I can withdraw anytime, and it has SWP also. It can generate cash flow anytime. So my only answer to them is, first, not everybody can withstand the entire volatility. Second, to generate good portfolio returns, you need a balance. To generate better portfolio returns, you need the right balance. Because when equity goes down, for example, in case of any black swan event, uh, which was like COVID was the last one, then you need liquid money somewhere else which you can push into equity so that you can generate massive returns. Exactly the same thing we did when COVID came, and we asked our subscribers to really get some money from their existing liquid debt based investments into equity systematically over 3 4 months, and today they are reaping benefits of that, and we don't know when the next black swan event is going to be. So liquidity becomes very important, and you need investments in non-equity so that you can utilize the black swan events of equity. So that's why I feel debt funds are a must-have in your portfolio, and you cannot do without it. Of course, what percentage of debt funds you should be holding in your portfolio, that completely depends on your risk profile and your investing strategy. For that, you need to get in touch with your financial advisor, who is going to be the right person to tell you how and what is the right balance for your portfolio. Okay, but till then, make sure you read more about debt funds. We have certain videos on our channel. Plus, you have the entire internet with you. Read more, understand more. They are a beautiful investment option. Don't undermine debt funds. They can really help you get wonderful returns with liquidity and cash flow. Thank you.